Hello everyone, I hope you are doing good. Friends, today I have come live to do this live AFM May 2025 question paper discussion. Overall, the paper was very good and easy, especially for those who have attended my class and who have focused on the ODBE book, as I have kept telling this earlier. For them, this should be very easy. Let us analyze each and every question one by one and check from where is the source from which this question has come. Some of them have come from the Mastery book, some of them have come from the ODBE book, okay, and some of them are there in institute material as well as in my book also. Let's just check this one by one, friends. As I rightly said, when you start the exam, MCQs don't start with it at the beginning because sometimes MCQs can become difficult. Okay, so I had recommended that we go with a detailed question and go with MCQ only if you feel it is manageable and easy for all of you. So now, when I checked these questions, part 2 was actually easier than part 1. So my recommendation would be to start with part 2. So in part 2, the first question that you see over here is a question directly from the ISM. So this question is there in your institute study material also, and the same question is solved in the mastery book also. The differences in the mastery book I have presented in my standard presentation format: basic data, analysis, and conclusion. So in this question, they have given you the current dividend, cost of equity, KE is given, growth rate is given. So basically, they want you to find out the price using Gordon's model. All right. So when you do it using Gordon's model, current dividend is a confusing terminology. You can assume it to be either D1 or D0, but you have to give your assumptions very clear in the question. My recommendation always is to assume current dividend as D1 because it means it is the dividend of the current year which is paid in the next year. Then they are asking you, is PQR's share overvalued if the share price is 45, ROE is given as 8% and the EPS is given as 2.75%. Friends, this is an exact question from your study material where they have given you the actual price and they want you to find out the theoretical price. After you find out the theoretical price, we will check if the theoretical price is more than the actual price. We would say the actual price is undervalued, so very soon the price will go up, you should buy. And if it is overvalued, what are you supposed to do? You are supposed to sell. And they have asked you to use two approaches: PE multiple approach, price earnings multiple approach, and earnings growth model. Two methods are given. PE multiple is nothing but MPS divided by EPS, whereas earnings growth model is nothing but E1 divided by KE minus G. I hope you're clear with this part. So if you write down neatly, working note 1 basic data, working note 2 analysis, and then conclusion, easily you can score 6 out of 6 marks in this one particular question. All right. Next one. Next question is a question on EVA. If I'm not wrong, they have given you the share capital, reserves and surplus, and debt is given. So all this together is what we call it as your invested capital. Invested capital. Capital, or whatever name you want to, amount invested, whatever you want to use it over there. All right. Cost of equity is given. Financial leverage is given. Friends, you would have learned financial leverage in your CA inter classes, but the same concept is used here also, so that you can go and use that data to find out your EBIT or EBT. Okay, financial leverage is nothing but EBIT divided by EBT. From that, you can work it out, and the tax rate is also given. From this data, they are asking you to calculate the economic value added. So, what is the formula for finding out economic value added? You have to find out NOPAT, step number 1. You have to find out WACC, and then you have to multiply with the invested capital, that is 600 in this case. Am I right? So when you do like this, if you do it correctly, you get full 4 out of 4 marks. Again, a very easy question. Friends, when the paper is easy, sometimes the valuation will be a little tough. But if you write down properly, working note 1 basic data, working note 2 analysis, and if you do it in this order, I can assure you one thing: very easily you will be able to score very good marks in the upcoming examination. Okay. The third question is a question where they are importing some raw material from China and they are manufacturing finished goods over here and then they are selling it. They are asking what are the type of risk faced. So friends, this is basically a question from the chapter of risk management. Over there, you have learned multiple types of risk. One of them is currency risk. So when you're buying it from China, there will be an exchange fluctuation will be there. You will have compliance risk coming in there. Laws of China will be different from the laws of America, because I believe, or India in that case. You're selling it to America, then you have separate laws over there. There can be strategic risk. Basically, all the types of risks that you learn, you have to write down over there. It is 4 marks. I would recommend you write 5 to 6 points. 6 points you write, you will be getting full 4 out of 4, or at least in this theory question, you will get 3 out of 4. Are you clear? Next part is a question on standard deviation. They have given you the standard deviation of R and S. They have given you the weight. Now they're asking you to calculate the portfolio standard deviation or combined standard deviation. If the securities are absolutely independent, if they are negative correlated, positive correlated. Friends, when you say negative correlated means what? It is going to be -1. If you say positive correlated means what? It is going to be +1. So what method are you supposed to use? Markowitz method. Standard deviation of X into weight of X, the whole square, plus standard deviation of Y, blah, 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 blah. I hope everybody is clear with this part now. Yeah. Okay. Next is a question on Forex. Friends, in fact, I have done a Forex marathon one day before the exam. This question was the first question that we did. Exactly the same thing has come. Only the numbers are slightly different. Those of you who had attended the Forex marathon, this 4 out of 4, you will surely get. Let me come down. Then they are saying question number 3 is a question on, I think, NPV. You're buying a new machine for 70 lakhs, additional working capital of 10 lakh, life is 5 years, 0 salvage value, company follows straight line method of depreciation, machine is having an incremental increase before cash of 25 lakh in real terms. There are 2 types of cash flows. You have real cash flow and then you have money cash flow. So in this question, if I'm not wrong, they want you to calculate the NPV in real terms. So when you say real terms means what? Your cash flow should also be real cash flow and your discount factor should be nothing but real discount factor. Tax rate is given, inflation is given, cost of capital is also given. From this, you are supposed to find out the answer on your own. I hope you're clear with this part. So you have to go by 3 steps. Step number 1, cash flows in real terms. Step number 2, your discount factor in real terms. And step number 3 is going to be your NPV. Friends, this is another question on security valuation. Exact question is there in my ODBE homework questions. We have done this question. I have discussed this question also in some of the classes, wherein they just want to find out what is the period for breaking even. A very, very easy question. 50 lakh is invested. Okay, they have an expense of 1.25 lakhs and they have an annualized yield of how much percentage? 9%. So there are 2 questions. One is if you want to have a pre-tax income of 5%, that is 50 lakh into 5% is how much? 2.5 lakhs. That is one way of looking at it. Second question is on break even. Break even means what? No profit, no loss. Everybody clear with this part? Next question is a theory question. Has demonstrated a weak type of efficiency. I have told you in my class there are 3 forms: weak form, semi-strong, and the last one is strong form. They want you to do different types of tests that can prove the weak form. We have learned in our class, run test is there. It's also there in our theory marathon, through which you can always go through. You have correlation test, you have run test. In fact, on run test, you have a question also that is there in your study material that we have already done in our classes, friends. Next question is an exact similar question from the chapter International Financial Management of your study material. This question is there in your ISM also. It is there in my mastery book also. Exactly the same question. All right. So in this question, they are asking you that they have an investment. Basically, it's a company which is a US based company. They want to set up a software in India. This unit will remain in existence in India for a period of 1 year. The software is expected to get developed in this time, for which there is a transfer pricing of 4 million. Software will be developed for 6 million, and then they'll have a lot of expense. Rent will be there, manpower costs, administration costs, etc. So we have to go and find out what is the investment, what is the money that you have to spend over here, and then you work out 2 NPVs. One will be the NPV of Indian company because Indian company is billing the US company. Second is the profit of the NPV of the US company because they are getting the lump sum revenue from the customer also. So that is how we work out this one particular question. Again, an exactly same question from your study material and in my mastery book. Right, let me go to the next question now. GL is having a PE ratio, 1 minute, has a PE ratio of 16 times, EPS is given, number of shares is given. Down they have given that there is an exchange ratio of 4:5. For 5 shares of FL, 4 shares of GL will be issued. Outstanding number of shares are 50,000. EPS of the merged entity is given. They want you to find out pre-merger EPS. It's a very, very easy question on mergers and acquisition. How do you find out pre-merger EPS? It is the earnings before merger divided by number of shares before merger. All right. Number of shares to be issued if pre-merger EPS is to be maintained. Friend, tell me, how do you maintain the pre-merger EPS? If the exchange ratio is in the ratio of EPS, your pre-merger and post-merger EPS will remain the same. Next is a theory question on tokenization. So friends, this question is over with this. It's a very easy question. 4 mark, 2 requirements. Easily you can score 4 upon 4 in this question. Tokenization is a theory part coming in securitization, which is covered in my theory marathon, friends. This is covered in my theory marathon. Everybody clear with this part? Okay. Or they have a question on VC. This is a question from this chapter of startup funding. Again, this theory of startup funding has already been covered, and this particular table, even though was not there in the PPT that I have given you, I had given a reference to refer this in the textbook, because these are the 4 types of stages that you have over there. Seed stage, startup, second stage, fourth stage. Okay, you have different stages, friends. Actually, you have first stage, second stage, third stage, fourth stage. Here they have given you second and fourth stage as such. Okay. This question we have done in our class, dividend equalization. Exactly the same question, friends, in the chapter of mutual funds. So those of you who have done this question in my class, I had given a beautiful chart explaining the complete logic for everyone. So those of you who have done this in my class, you will easily get full 7 out of 7 for this particular question. Next is a question on, let me check, electrical equipment. They have given a data below. Break even achieved, EBITDA is given, extraordinary gain is given, pending adjustment is 38 lakh is given, unlevered beta, capital structure, RF, RM, equity value has been given pre-tax. Okay, it's a question on valuation. So they want to find out WACC. So friends, in this question, from this data, we have to go and do the free cash flow method. What are the steps involved in free cash flow method? Step number 1, calculate the free cash flow. How do you calculate the free cash flow? Future PAT plus depreciation minus capex minus additional working capital. Everybody clear? Then find out WACC. How do you find out WACC? KE into weight of equity plus KD into weight of debt. How do you find out KE into weight of equity? RF plus beta into RM minus RF. How do you find out KD into weight of debt? That is nothing but cost of debt after tax. So you have to take the KD after tax. This is pre-tax, you have to take post-tax. Friends, same question we have done in our class. We have done a question on free cash flow method. This is exactly the same thing that we have done. Next question. Friends, this also we have done. Do you remember a question on initial margin, maintenance margin and mark-to-market margin? Yeah, same question, but there is a slight deviation. In this question, they have given you the daily balance in the margin account. Okay. Then they are telling if the contract is squared off, what is the gain or loss to Mr. RS? Last part is the opposite thing of what we have done. So in our class, we have taken the long position and we have done it. Same thing we can also do it. Same table that we have done with short position. So what happens when it's a short position? When the price falls down, you make a profit. In long position, when the price goes up, you make a profit. So this is one part which I can tell is slightly different from the adjustment that we have already done in our classes, friends. All right. Yes. Can I go to the next question now? It's a question on cap, collar, floor. Friends, we have done this also in our class. They have given a cap rate of 8%. It has got a premium of 0.075%. Arising interest rates is given. So you want to analyze the following situation. If the interest rate goes up to 10, your cap rate is how much? 8. Above that, 2% is going to be your profit. So, okay, minus whatever premium you end up paying on this particular thing. When you purchase a floor and if the interest rate goes up, you make a loss, because in floor you make profit only when the prices are or the rates are falling down. Okay. If the rates falls to 4%, you have cap and floor. Cap will be lapsed. Floor will be exercised. Everybody clear? If the company, so basically it's a question on cap and floor, and same easy thing, friends. We have done a much tougher question in the class. This question is for how many marks? I'm not able to see the marks over here, friends. Maybe in the scanning it has been missed out. Whatever marks it is, it's very easy to score for all of you, friends. So this was the main question paper. Now let's come to MCQs. Friends, many students told me the MCQ was very tough, but trust me, they were not very tough. This question we have done in our one-day marathon. Same question has come in the exam. So those of you who attended the one-day marathon, this question was very easy. Number of shares, market price per share, everything is given. And then from this you get the NAV. Subsequently, if they give you some extra information, based on this extra information, you have to work it out. As simple as that. It is an NAV based question. Very simple. How do you find out NAV? Total assets at realizable price minus liability at realizable price, whole divided by what? Number of units. Then you have a case scenario number 2. Mr. X buys the stock of WBL for 21 lakh 60. Okay, very strong fundamentals, blah blah, marketing mind, beta is given over here. Nifty spot, this I'll call it as S0 Nifty. This is future, so it is it is going to be F0 Nifty. That is 2310. They have given you the spot, and this is your S0 in the spot market. Okay, so how do you find out the perfect hedge? S0 in the spot market into beta into what? Into 100%. So like that, 21.6 into 1.3 into 100% will give you the perfect hedging formula. So that will turn out to be 21,60,000 into 1.3 is 28,08,000. Now you have a contract size. They have given you the Nifty futures value is given. They would also be giving you the market value of this Nifty future. Once you have that, the multiples are traded in 240. So when you do 2310 into 240, what will you get? You will get the contract size. Then you have to divide it with that to get the number of contracts. I hope you are clear with this part. Based on that, they have asked you all these questions, friends. We have done all this in our class. Very easy. I will not say this is a tough question, but yes, being futures, some of you might find it difficult. Then friends, this question has a receivable of 20 million. We have done the same type of question. $364,897 was a number in my question. I don't know how many of you remember that. Same thing. We had a payable. They have a receivable. That's all. They have given you the option market, and then they are asking you how much money will you get under future, how much will you get under forward, how much will you get under no hedging, etc. Okay. Fine. Forward strategy, how much will you get? End of 6 months, if you go for no hedge, what is going to be the rate adopted? Very simple question, friends. I would not say even this was difficult. Even this was very easy and very much manageable. Case scenario number 4, friends, portfolio management. Same question done in class. Boom, normal recession. It's a question on alpha. We had done this in class. So here they have assumed the CAPM framework is valid and choose the correct answer. Same question. I think it's question number 4 or 5 in our ODBE material. They're asking you to find out the variance of market MP, M minus M bar, P into M minus M bar the whole square, or they would have given the formula. Covariance is given, for example. So we know that correlation is, or beta is nothing but covariance divided by variance of the market. Like that, we can play around and we can always get these numbers. What will be the beta of stock A? What will be the beta of stock B? We know the formula. Required rate of return of A and B. Alpha, expected return minus required return. Everybody clear with this part? So friends, and expected return is also given. In the absence of information, expected return and CAPM return will remain the same. All this is covered, friends. So I'm very happy to let you know that our efforts were not a waste. We have done our part. if your presentation is also clear. Now friends, you have to be clear about one thing. Since the paper was easy, valuation will be a little tough, but if your presentation is professional, I assure you, you can easily score 70 plus, 80 plus, or even 90 plus. That was the dream that we saw in the class, and I'm hoping that dream will come true. When this dream comes true, please don't forget to message me and let me know about the marks that you have scored. Thank you so much, friends. Have a nice time ahead. Take care.